Did the CPI gap up cancel the market crash? Well, with the follow-up gap on Friday, and strength from the banks kicking off earnings season, it would seem so, but after Thursday's session specifically, we have a new problem for markets, and it has to do with one of the largest influences over the S&P 500. So welcome back to the Trade Brigade Weekend Show, where we'll cover that problem in particular, and take a look at all of the data points to build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got a solid green-bodied bar, not much upper wick to really read into here from a psychological perspective, and a very strong close from the buyers at the top of the weekly range. Structure is absolutely bullish. If we think about location on the bar-to-bar count, notice that we did gap down on the Monday morning open, producing a lower low, and we've actually produced a lower high here as well. It's very subtle, but it is technically a lower high. So in theory, location-wise, lower high, lower low would be bearish, but I'm going to go out on a limb here and just call this more of a neutral location. Reason being is that on the gap down open, if sellers were really going to step up in this market, it should have just been a gap fill reversal. And the other thing that should have happened if sellers were going to be more aggressive here on the location front is just some sort of lower high rejection underneath 585. I mean, how long have we been talking about previous resistance turning into soft high or low support? No candle close below, no candle close below. Finally, there was a bearish candle close below. So you would think if we had stronger sellers in this market on the gap down open Monday, it would have once again been a lower high gap fill reversal or 585 retest, lower high reversal for a weekly substantial lower high underneath the key level. Now, clearly, neither of those two things took place, which once again, on the location front, is why we're more neutral. So what does it mean in the grand scheme of things here? I think a couple of takeaways on the weekly are very important. Number one is that the back-to-back round trip action we've seen in this market, aka volatility, is still here. It doesn't matter what the VIX is doing, just look at price action. Straight down, straight up, straight back down. Obviously, we opened here, right, to go straight back down, and now we're straight back up. So we'll see this as the daily range in just a moment, but the size of these weekly candle bodies, to me, are still an indication of volatility. Number two is that the bulls probably have some sort of edge if we can stay over 585 and we can see a bar-to-bar high or low produced there for some sort of attempt into the equal high. Now, this is not without saying if 585 does not hold and the market finds itself underneath 585, then what do we have then? We have highs and we have lower highs. That would start to kick off a very subtle, but technically there, weekly downtrend. Okay, so that's the top watch here out of the weekly. A couple of other indications that can help us understand where these inflection points are and why they're still so useful. The Fibonacci's from the August 5th low to the all-time high, all of this is over the Fibonacci 38.2. So in the grand scheme of things, is the weekly chart really in jeopardy of flipping to an aggressive downtrend? I would still maintain that the answer to that question is no, and it's been no for a very long time, right? We had said that really, as long as we have a move that's over the 38.2, the worst the weekly chart could be is some sort of neutral outcome on the trend front. Now, maybe that changes subtly if we do produce some sort of lower high here, but we're not there yet. As of right now, the most recent failure of the sellers to materialize a lower high underneath 585 really gives the buyers the benefit of the doubt as of this weekly close. Let's come in one more time with the Fibonacci from the low of the election bar up to the all-time high. And the call out here is that we've now closed back over the Fibonacci 38.2 from this perspective. Just last week, we had closed underneath the 61.8. So I'll continue to reinforce the idea that here we want to watch for more time, more acceptance on either side of either the 38.2 in this case, as of last week's close versus the week prior. We only spent Monday and Tuesday underneath the 68.1, and the remaining 3 days of the session for the weekly bar were above the 61.8. So if we see Monday, Tuesday, Thursday, Wednesday, if we see a bunch of days accepting, I realized I said those out of order. If we see acceptance over the 38.2, for more than just 2 days, maybe the odds favor, with this more recent bullish edge on the recapture of 585, some sort of rotation back to the all-time high to prevent some sort of lower high here. If on Monday and Tuesday we start to see the market fall into the midpoint here, then what do we have? It's just a classic indication of range compression, where I could say something like this, and we'll be patient for a break of the trend line in either direction. right? So that's the state of the weekly when it comes to Fibonacci's. Let's check in on our anchored view apps here. And this also, I would say, reflects more of the failure from the sellers than it does the strength of the buyers, right? So here, again, our key level is very clear. It's the bottom of the upper anchored view app stack. Notice that there was no lower high attempt here. There was no lower high attempt here. There was nothing at the upper two. There's no weekly upper wick, and we close over the top end of the entire anchored view app stack. And we're still supporting over this August 5th panic move, right? That anchored view app acted as support. So although last week, or I should say 2 weeks ago, the red close underneath a majority has been recaptured, although we had that bearish flip, it's just a very volatile market. And one of the themes, if you've been tuning into the episodes, for the last almost month at this point, is to not be a hero in this box when the weekly trend gets a little bit rocky, right? So let's take a look at our final indication here, and that's really been rewarding, right? If you have not held on to some sort of overall bias, if you haven't been like, okay, the market's going to crash and go to zero, or oh my goodness, we need new all-time highs tomorrow, that served you well over the last little bit, right? So let's come in here with the 585 level, right, which is the high volume node. We've obviously closed back above. What does that mean? Again, the bulls probably have a subtle edge here as we come into the upcoming week's worth of trade, looking for a 585 higher low or some sort of equal high right out of the gates to keep the weekly trend back firmly in the upward direction. Let's drop this thing down to the daily time frame chart. Let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. What do we see? Upper bound is at 606.35, implying a higher high, notably over this level right here. That is important. And also, it's a higher high into this previous range over 603. 603 is really the threat of a weekly potential lower high if something is going to persist, right? So that is bullish on the upper bound. If we're contained by the lower bound, it's right here at 588.77. That's basically right on par with the Wednesday low. It's the top of the CPI gap. If we can hold up for a higher low above that, what does that suggest? It suggests exactly what we were looking for out of the weekly time frame chart, where this suddenly is a bar-to-bar higher low. It's clearly, from a daily trend perspective, let's clear this up a little bit. If we get something that holds down here, right? It's clearly a daily higher low. It's the weekly bar-to-bar higher low. I would have to maintain at that point much more of a bullish stance in the market, looking for some sort of equal high breakout here back to the all-time high, right, from the daily perspective, if we see a hold of the lower bound of the weekly expected move. So the trend here, though, do we yet have a bullish uptrend on the daily? I don't think so, right? And you're going to hear a number of people talking about like this resistance trend line and how, depending on how you draw it, it's still there. That's fine, and maybe there's still a lower high from that perspective. You could come in like this and say, no, we've broken the resistance trend line. This is why it's too subjective to use diagonal trend lines in my perspective, right? The best thing you can do is just count trend. This is a set of highs. This was a lower high. This was a lower high. This is an equal high. So is the daily trend up? The answer is no. We are in a neutral daily trend perhaps, but we're still coming from the lowest low in the trend count, right? This was a low, this was an equal low. The Monday gap down instantly produced a lower low. So are we free and clear? Are we out of the woods from a bullish perspective? Is it time to go back to all-time highs? The daily trend is not yet up. I'd say that a daily higher low could solidify that. And if we do respect this key technical level we've just described, 588.77 is the lower edge of the weekly expected move. Wednesday's low, 589.25. If we get some sort of hold of that area, then great. That starts to change the weekly trend to up. We would say that, hey, from here to here, now we're dealing with that higher low, as we've just mentioned. Looking for an equal high breakout should bring us to 603. That's going to be a big battleground. That's basically the origin of the Powell plunge as well. 603 is a big battleground, and if we can get through that, we're looking for 609, all-time high. So a couple of additional takeaways here. Let's start talking about candle structure on the daily time frame. We do have ourselves a technically bearish inverted hammer on the Friday session, where the end of day fade from the highs did yield a little bit of an upper wick. We're seeing some selling pressure step up at the sort of known resistance level, this previous lower high. Is that logical? The answer to me is yes. Note also, though, that we were extended through the upper bound of last week's upper bound of the expected move there. So again, reasonable for sellers to step up? I think so. We've recaptured the daily 50 SMA. We had an additional gap up on the Friday session that did not close all the way, which is worth talking about, right? If we had stronger sellers participating in this market, then in theory, on Wednesday, the sellers should have closed the gap here On Friday, the sellers should have closed the gap here. The fact that these things remain open in the market is just an indication that stronger sellers aren't really stepping up. So on the daily time frame chart, in addition to the weekly analysis we just conducted, I would tend to think that higher lows are an opportunity here as long as we're over, you guys can call me crazy in the comments section, that's fine, but a higher low is possible on a full CPI gap fill reversal. If we could hold from here to here, inside of the balance range, most notably, right, the reason I would call this the line in the sand for the higher low is because it prevents a full rotation back down to the bottom end of the balance range here at 580.75. So a full CPI gap close 584.75, I still might be, open-minded to calling that some sort of higher low. Now, of course, what's the sort of neutralizing action to take? Well, if these are still just equal highs here, you still can't quite call it a daily uptrend. So, as I'm expressing my thoughts here almost in real time, analyzing this chart with you, I think the moral of the story, right, is still we don't want to be a hero in this box. If you're calling for, hey, all-time highs are going to be here in the blink of an eye, maybe we've uncovered that there's a subtle bullish edge, but do we have a full-blown uptrend yet? I don't think you can confidently say the answer is yes, right? And there are some indications with the inverted hammer rejecting a known area of resistance, a couple of thin structure retracements underneath us, right? There's reason to believe that a pullback might be reasonable, but that pullback, right, again, flip-flopping between both sides of the same coin, the pullback is just a pullback. It's not yet like, hey, market's crashing, right? Market's crashing is really price acceptance underneath the bottom of the range, which we did start to get on that Monday session via the gap down. That's 580.75. So you can see the conflicting points of view. And I think what we need to do is just continue on down to the hourly time frame chart. And we'll get into some supporting evidence as well. But let's build a pathing game plan here based on what we know from the weekly and the daily, right? So ultimately, this consolidation here is pretty bullish, and I would participate in Brigade bolts for trades from point A to point B at 603 as the target. Now, we know 603 is a very important level, and we should certainly reevaluate the chart when and if price makes it there. That's a reasonable setup, A to B, right? You can manage your risk, reward. There's an intraday scalp that happens there. If you're a swing trader, does it make sense to be buying this up here with potentially a stop, reasonably, maybe something that looks like this, for a move into the all-time high? I would say as a swing trader, the time to be entering this would be down here. As a day trader using smaller time frames and smaller time scales, ranges to traverse through, this is certainly a little bit more reasonable, right? This risk, this reward. And we'll see if we can balloon runners on a recapture of 603. Now, of course, what do the swing traders want to see? Maybe some sort of gap fill reversal. That flies here off of, flies as in, I would accept that as being reasonable. I want to be careful to not say flies as in, oh, here comes the all-time high, right? Gap fill reversal, 594.25. That looks pretty solid to me. I would say that you might have risk and ultimately reward for a retest of 603. If we can set a higher low, I would expect some sort of equal high breakout to try to continue flipping the daily trend to up, right? So that's where that 603 target comes from. So point A to point B becomes reasonable. It keeps the hourly trend up as well, right? If you're thinking about what the hourly trend is, we have lows, higher lows, higher lows, higher lows. This, of course, could be higher lows. Gap fill reversal maintains higher lows. We're good to go on that front, right? Now, if the market pulls back a little bit further underneath the 594.25, so say it, moseys around in the gap and gets acceptance in here, do I think that there's a strong short to be had there? Personally, no. I look at this activity from the Wednesday and Thursday session and say, I'm not really interested in taking big ambitious positions inside of a choppy range, right? So, how do you participate short? Let's play devil's advocate here. If you start to see a break over 599.65, this previous pivot high, with some sort of lower high acceptance back inside of range, you could start a possible short position because, again, every trade is its own trade. It's its own traverse of the range, traversing of the range in this range that we're dealing with on the daily chart, right? This here. I think that this lower high possibly sets up some sort of risk reward to close the gap. And if you wanted to try to balloon runners into this choppy range, then be my guest. But if the market just sees a straight shot lower here, I would not be so ambitious about setting up new short opportunities inside of the choppy range, right? I think that this is too much of an area where maybe an arbitrary higher low gets set, the market bounces around in there and then finds its way out of it. I would say that if we get a deep dive into that range and then set a higher low back over 594, basically the 2-day highs right here, 594.25, that would be then a Brigade bolt for the upside, looking to trade upside outcome. So, I'm catching myself as I'm going through these scenarios with you here in the video. Almost anything flies when the daily trend is neutral, and it's not going to, the comment section's going to go wild, like, oh, this guy says the market can go up, down, sideways, whatever. Like, you have to understand that is, like, everything you're saying is a true possibility from the market if you have that stance, right? I know a majority of folks are like, oh, no, I appreciate the levels, appreciate the analysis, that's great. But generally, if the trend is neutral, then you're absolutely right. And, I think it's correct to say that almost anything goes in here, and you need to maintain that diligent, sort of flexible mindset where you can say, okay, I'm looking for the long here on the gap fill reversal. Oh, it doesn't play. I'm not really interested in here. Oh, it Brigade bolt back above. Maybe there's now a long here, right? You need that ability to stay nimble as the daily trend has not truly resolved one way or another. So just sort of getting the thoughts out of my head as I'm going through this and thinking to myself, what's possible this week? A wide variety of things, right? Really a wide variety of things. I would say if you're looking for the short, just to appease the bears in the chat or the comment section, whatever you want to call it, the look above and fail is probably the best short opportunity that I would entertain, or a rally that starts to reject 603. Those areas, to me, seem like decent locations for risk-reward shorts to present themselves, right? I would not be aggressive in here. If we do get some sort of move into the CPI gap like this, there's absolutely a scalp because it's thin structure, right? From point A to point B, but at point B, as we've described on the daily time frame chart, I really do believe that that is the place to start looking for a potential DHL shipment. There we go again with the DHL shipments, daily higher low. Right? 584.75 is my line in the sand for that daily higher low. Ideally, it's above, right? Ideally, based on some of the bullish analysis we did on the weekly with that retracement over the anchored view app structures, right? Ideally, this perhaps resolves like that, right? Anyways, some supporting evidence. What else can we see here? Let's come in from the Jerome Powell plunge, the high back here, to the lowest of the lows. We're over the Fibonacci 61.8, meaning that the 100% retracement is more likely if we can stay above. Notice that the 61.8 is confluence with the gap fill reversal from the Thursday high, closing the gap up from the Friday morning open to Thursday's high, right? So that makes sense to me. That would be a bullish place to watch. And once again, that is a decent confluence, 594.25. Let's come in with the intraday anchored view apps. And what do we see here? The all-time high anchored view app, which is this one from back over yonder, is slowly going to creep up and also be confluence at 594.25. We can see how that's a key level. If we get down into this sort of zone in here, the reason I don't want to be an aggressive short just arbitrarily through this area is because if you take an anchored view app from the top of the move here and the bottom of the move here, these will slowly start to catch up and be tangled up in this area. An arbitrary higher low in that range could very well be possible. I do think that the best short, if you're not shorting these higher levels for a counter trend move right here and potentially here on the failure, would have to be patience until we see this gap close underneath from the CPI move. Once again, 584.75, 589.25. And with that, let's jump on over to the market internals because I feel like the S&P analysis is dragged on a little bit today. Here we go. If you're not familiar with the market internals, take a look at the video tutorial in the top right-hand corner. What do we see here? What's going on at the exchange level? So certainly on the Wednesday session, let's acknowledge, right, that we did have substantial volume inflows here. However, let's compare what happened on Friday, right? Obviously, the gap was not, as large on the Friday session. However, we did have a gap up, and it did not close all the way. Did we have substantial volume inflows on the Friday session? The answer, of course, is no. We had pretty mild volume inflows there. And if you actually take a look, if I hide that study and we can look at the intraday breadth histogram, for the most part, it was not even substantial over 2. Versus Wednesday, all day, the breadth ratio was more so hovering around like 5-to-1 positive, right? So Friday's rally, which we acknowledged had an upper wick with the fade into the afternoon session, right? That daily inverted hammer really wasn't as supported at the exchange level as the gap up we saw on the Wednesday session. And you can see that here in the advanced decline line as well. We fade from trend higher zone to 0 versus staying above or in trend higher zone all day. The index score intraday was not nearly as strong. And if you look at the cumulative build out of the tick, it actually closed negative. So again, does this pullback thesis that we've outlined so far for the S&P seem reasonable? Some consolidation here before a Brigade bolt or heck, a gap fill reversal and something that looks like this, risk reward. Does that seem reasonable based on the internals, not really confirming Friday's move? To me, the answer is absolutely. And I think that that also aligns with not being overly aggressive on the bull side as we're still just, in the balance box as we've described for the last little bit. Here we go. ES Futures, taking a look at the market profile. If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. We can see the gaps, right? So this is the gap up on Wednesday, and this, of course, is the tiny unfilled gap remaining from Friday. But generally speaking, the point here is that if you take a look at value on the Monday, Tuesday, Wednesday, and then Thursday and Friday sessions, it's all overlapping to up, right? Overlapping to up, completely clean in the upward direction, overlapping to up technically, and clean in the upward direction. So are buyers getting acceptance at these higher levels? I would tend to think yes. If we had one of these sessions, notably Thursday on that consolidation, it was almost an inside bar, right? If we had value that was overlapping to down on that Friday session, something that looked like this perhaps, that maybe brings into question, any sort of confirmation of breaks in the upward direction, right? But obviously that's not the case. We just talked about how value is moving higher. The next thing to point out is just that there's a lot of poor highs and lows left in the aftermath of this gapping market, right? So first and foremost, this has been repaired technically via the move through it on the Friday session. But, lack of material excess on Thursday. I would say we have decent excess on Friday in the A period lows, but certainly lack of material excess on the highs of the Friday session also. So would it be unreasonable to see a test through that and that failure back underneath to set up a pullback? No. I think it would be reasonable for the market to repair the poor high. The auction did not end properly. Test and repair by going through any acceptance back down in range, that lower high, again, not as an Armageddon short, not, oh my God, the market's crashing going to zero short, but as a pullback short makes a lot of sense based on the market profile information here. Let's jump back on over to the platform. Let's jump into, of course, our good friend, the nasty NASDAQ here. QQQ, weekly time frame chart. Let's go with a clean drawing set and let's see what we can see. So what do we have in terms of candle structure and location? We certainly have a solid green-bodied bar, which of course is more bullish on the structural front. On location, just like the S&P 500, lower low and lower high. The close isn't quite as strong. What you'll note, if I just quickly go back to the S&P, is that we closed over the previous candle's opening print on the QQQ. Notice that we did not. We did not close over the previous bar's opening print. Not the end of the world, but still just something to make note of, a subtle difference between the two. Undoubtedly, the strongest point out of the QQQ weekly, which is why we were not aggressively bearish. If you watched the full video last week, you know this, right? And even people who are going to miss this data point, I'm sure are going to be going crazy in the comments below. But the reason we were not aggressively bearish is because the NASDAQ is still over its previous all-time high. This is nothing more than a weekly time frame Brigade bolt, right? You classically have a break, higher low that gets set above, and you look for continuation in the upward direction. If you've been tuning into the pre-market sessions, you know this. And again, these are the folks who, are following along the most closely, I'm sure. But we were unable to say with any major degree of confidence that the NASDAQ was rightfully some sort of bearish development, right? On the move lower through this mild pullback is what I would call it on the weekly. So for me, that's still the case. We're over this level. Nothing has changed about that. If we come in here with our Fibonacci's from low to high, all over the 38.2, if we come in from here to here, over the 38.2 on the close. We held the 61.8. We opened below, but again, that rally was pretty prompt. No time really spent underneath that. And once again, the horizontal level really just makes the most sense. We're all set here on the QQQ from a fib perspective. What about the anchored view app perspective? These are not even being tested. This has held, and we're above the top end of the stack. So bullish on the weekly time frame chart still on the good old NASDAQ. Let's check in on the volume profile weekly. Let's go with we want a 9-month chart. We'll do. That'll be just fine. I appreciate you guys bearing with me, especially as I make some chart adjustments on the, on the fly here in real time. Where did we close relative to some high volume shelves, right? This, of course, just being the previous high, was a high volume shelf. We supported off of that. What about this little node here? We did technically close above that. That's interesting to me, and therefore, there's really not much volume resistance, not much overhead supply if we were to think about, what literally exists above as potential levels. So with that, let's take a look at the daily time frame chart, get a little bit more granular here on the NASDAQ, looking for some particular ideas for the upcoming week. And remember also, I didn't mention it in the intro, but of course the market's closed on Monday in observance of MLK. And of course, we have the inauguration that day as well. We already pointed you to the weekly expected move video tutorial, so there's probably nothing there in the top right-hand corner. But anyways, what do we have here? It's 531.68 and we have 511.79 on the downside. This is a bullish weekly expected move with the forecast of a potential higher high over this previous pivot and a potential higher low from here to here. here. Note that the CPI gap is not as severe out of the NASDAQ compared to what we have over in the S&P 500. And one of the reasons, sneaky reasons that we didn't really discuss yet, is just simply because the NASDAQ does not have any financial companies included, the NASDAQ 100 at least, right? So without the inclusion of the JP Morgan, Citibank, Wells Fargo, BlackRock, Goldman Sachs, like all those guys were gapping up on financial earnings, right? No influence of that over here in the QQQ. So this is much more of a pure look almost at the CPI gap up. A little bit more of it closed, there's less of it left, but any higher lows that remain over 510 certainly give the opportunity for a daily higher low. And at that point, who knows? From a pattern perspective, maybe we get crazy. Maybe we start talking about an inverted head and shoulders. We're over the 50 SMA. A couple of things that are slightly different is the objective trend line. There's no other way to really draw this one in the NASDAQ versus the S&P had two. The trend line is undoubtedly broken here in the cash market, which of course is slightly more bullish than bearish. But once again, my preference is to always just count trend highs, lower highs, lower highs. This certainly could still be a lower high, even though you've broken the trend line, right? So what's the ideal outcomes here on the NASDAQ? What's a picture perfect setup? Well, we closed the gap on Friday. We already found support. We found buyers at 518.50. That's the note here based on the lower wick. So if we can stay in a picture perfect world over 518.50, I would be looking for breakouts over Friday's high, 523 basically, for a rotation into the equal high, which starts to neutralize the daily trend. As of right now, I know it might sound crazy based on everything we've already talked about, how on the weekly chart we're still bullish, right? I know it sounds crazy, but if you're counting trend coming from the lowest low with the opportunity still for a lower high, you have to call this a downtrend, right? It's still a downtrend on the daily time frame chart NASDAQ. So until we neutralize that with the equal high and a break over 523, that's the case. Holds of 518.50, keep that in play, looking for that throughout the duration of the week. Breaks underneath 518.50 are probably shortable. Did he say it? Yes, I said it. Probably shortable. Just because, again, you're still in a daily downtrend technically, and I would change my tone on that if we can support 510 for that more meaningful higher low, right? That would keep us inside of the box here, and again, maybe it turns into an inverted head and shoulders, so on and so forth, but in the grand scheme of things, as the NASDAQ is still resolving this range, as it's still technically speaking in a daily downtrend, I think you want to be diligent and, again, open-minded to a wide variety of outcomes. If we do produce the equal high, I will become more neutral, and I will be, at least on the daily, right? And that would start to align more so with the bullish thesis out of the weekly, which is continuing to maintain this 503.25 level. Over the 50 SMA we talked about already. Let's drop it down to the hourly time frame chart. Let's see what we can see here. So what are the pathing ideas? How does that short trade actually unfold, right? This, to me, is an idea worth entertaining, and I would probably take this trade in the NASDAQ rather than the short through some sort of forced balance range in the S&P 500, once again, because the daily trend is still down. If the daily trend was neutral, I probably would not have an aggressive stance on some sort of breakdown through this range here. So it's a scalp from A to B, and then at point B, just like the S&P 500, just like the daily time frame chart, I would reevaluate and look for a higher low to ultimately start setting the beginning stages of a daily trend reversal, which could be up, right? So you would want to participate. Here's just in general the paths that I would like to participate in, right? Any consolidation here is great. Brigade bullets here, awesome, neutralizes the move. We would say from A to B, you have, of course, risk, reward. That's a bullish outcome, of course, right? The next one would be something that looks like this. If we look above and fail, you could maybe set up a short on a back test that accepts inside of Friday's range, risk, reward, first target here, ballooning runners down to 510, right? The additional follow-up to this idea would be something that looks like this, trying to set up risk, reward for a new entry there underneath 518.50. When we get down here, so let's say that the short plays out, right? Here it is, great, everybody's happy on the short side, bears rejoice. When we get down here, it is risk, reward, right back to the upside, right? We are in a very clear neutral hourly trend, I would say at this point, maybe trying to flip to up with lows, higher lows, higher lows, highs, higher highs, higher highs, but the daily, being conflicting, still technically remaining down, leaves basically all of those opportunities on the table, and I would be open-minded to almost all of them. I would say the weekly time frame chart, if I'm going to draw influence from that higher time frame and say what would be a picture perfect, like if you could only give me one setup, what would be the one I would take my shot at? Probably looking at the bull side at 510. Right, something that looks like this, I'd be very interested in that possible idea here to set the higher low. That is my preference out of the Qs if I could only have one, right? Let's come in with a couple of additional indications. Powell plunge Fibonacci sequence right at the 61.8 instead of above. 38.2 is kind of a no man's land. It's not really up against that 510 for beautiful confluence, so not learning a whole lot about that. We could come in from the most recent leg to the downside as follows here. 38.2 there is a little bit better alignment at 510, and this is decent at the 61.8, so I think it just reinforces 510 and 518.50. And if we come in with the intraday anchored VWAPs, right, what we can see here is that we're above the entirety of the cluster, and as we've made note in the S&P, these will start to migrate higher. I do think that, again, the whole reason why I would prefer to be a long off of 510 if I could only have one idea for the market is because, this is technically still true here. If you're looking for that short, you are having to battle through these instead of just already being underneath, or they're not all above us. That's the same thing basically, but you get the idea, right? This will provide some hang up, maybe make the short a little bit harder than it has to be. So that's what I've got for you here on additional indications for the NASDAQ. Let's check in on the internals for the NASDAQ side of things. On the Friday session, notice that as we had buyers off of that 518 level, right? What did we have at the exchange level volume flow wise? Definitely strong volume inflows, confirming more of that support long off of the morning flush, basically. The advanced decline line did move slightly lower, but not all the way to the zero mark. And notice that on the NASDAQ, the cumulative build actually closed out positive as well. So, I do believe that positive, more bullish stance, the whole reason why I said that this is something I'm more interested in participating in, it's really a culmination of all the data points we've seen for the NASDAQ so far. Let's get on over here and quickly take a look at the market profile. This looks like we'll have to readjust that. A little refreshing in the background. Thanks for bearing with me again. What do we see here? Value area. Value area is overlapping to up. Here it is. Here it is completely overlapping to slightly up. I mean, if you technically draw a line from here to here, there's a small upward slope to that. And on Friday, certainly moving higher as well. So on the gap fill reversal, value, staying high in the overall session, to me, is more of that indication, once again, that buyers are trying to step up in the NASDAQ. It's just a matter of confirming that daily trend change back to up at this point via some sort of equal high and then a higher low in the sequence, right? Let's get back on over to the platform here and let's finish up the broad market with everybody's favorite, Rusty Russell. What's going on with the small caps? Let's take a look at the weekly time frame chart because we are not out of the woods yet. Not out of the woods yet. Here we go. Candle structure and location. Rinse and repeat of everything we've said about the S&P and the NASDAQ. Basically, solid green bodied bar, gap down open, lower high, lower low. Yes, this one closes at the opening print of the previous weekly bar as well. But most importantly, we know we've been tracking this level. It's a very easy one to watch. We're not claiming to be geniuses with this level. It's 227. As long as the IWM is underneath 227, this, in theory, is a failed weekly breakout. This is possibly, I'm not going to say it's in play yet. You need a shoulder and a true neckline to break, but maybe it's a head and shoulders. Again, we're not there yet. I would say as of right now, it's all about 227 from the weekly perspective and the daily. It's all about 227. Do we resolve it higher or does the weekly pull back? If it remains underneath, you're probably going to see some struggle in the S&P 500. Maybe not so much the NASDAQ, which is why I would prefer to watch for that 510 higher low there and remain somewhat neutral in the S&P if small caps still struggle with 227. Let's quickly check in on the anchored view apps. We'll get back to the fibs here in just a second. These are barreling down for a potential area of resistance. The other two indices closed above, right? This did not interact with this, and this, of course, overshot and has recaptured the anchored view app from the bottom and basically the top of the defining points of the range from back here, which, again, we tried to see through this breakout, but obviously, as of right now, no dice underneath 227. Let's check in on the Fibonacci's low to high. Here we have it. Still rejecting that 38.2. Great confluence with the level, so still all set there on 227. We can also come in from the top to the bottom. Let's say that the gap down is truly going to mark the end of the move there. This is still just bear flag consolidation underneath the 38.2. We're not out of the woods yet on small cap, so we know this, right? Let's come in with the volume profile. This should not be a shock that we are over the high volume node, right? That was just, we knew it was subtly underneath the top end, of the breakout point. So we're back above that. Maybe it gives the buyers an opportunity for an inside consolidation candle this upcoming week, and then possibly an attempt at a break into the future. This would align with more of that bullish trend change back to up over in the S&P. But again, one step at a time. This could easily just become, right, break lower high underneath, and now all of a sudden it still just continues to look like a failed breakout on the weekly. Let's take a look at the daily time frame chart. Weekly expected move is up first. What do we see here? We've got 229.94 and at the lows 220.97. So technically speaking, a bullish weekly expected move with the opportunity for a higher low from here to here and a break from here to here over the weekly level, 227, the big bad number. With the CPI gap up, we all know that small caps are more sensitive to economic conditions, right? So this to me is one of the reasons why I might continue to maintain a bit more of that neutral stance unless we have a new catalyst come into the market and just, blow the top off of something like the tech sector. Financials, maybe a little bit, but really the fact that on the CPI gap up, yes, IWM moved higher, but it was unable, and it has been unable to recapture 227, leads me to believe that the market's still somewhat worried about inflation. I have some thoughts about inflation as we move further through today's episode. So if we're still underneath 227, it's something that we have to continue to keep an eye on, just in terms of not having the Fed and that fundamental narrative fully resolved to okay, guys, rainbows and butterflies, inflation's all set and the labor market's still strong, right? The small caps aren't really buying the BS basically on the Wednesday's report, right? So anyhow, 227, it's very obvious. If we do come back in and close the CPI gap, it's possible for some sort of higher low, as we've mentioned, but is that bullish? Am I shouting from the rooftops, oh my God, it's time to long the S&P 500, we're going to all-time highs? No. If this builds out over time, and again, the pattern traders out there, rejoice. If we get something that looks like this over time, then fine, but we're just not there yet. We're not there yet. We don't have a right shoulder. We don't have a neckline break. We're still underneath 227. We faded the entire gap on Friday, and we did not close as substantial, at least as compared to the QQQ, a lower wick. So let's take it on down to the hourly time frame chart where we can just see, be my guest if you want to trade the range down here. I'm not much of a range trader. I prefer to trade trends. So I'm going to be waiting patiently. It's either going to do this and Brigade bolt up and out of 227, in which case I'll use that as a tailwind for the S&P, or if it just chops around and fades the gap to the downside, I'll use that as a headwind for the S&P 500, but I will not explicitly trade the IWM here at this 227, okay? So those are the paths, those are the ideas. One very subtle and interesting note, which is kind of counter to the slightly more bearish tone I have here on the IWM without that break of 227, but if you read the tea leaves and if you bring out the microscope, right, what do we see here? Technically speaking, on Thursday's session, and this is important because you did not see the same test on the NASDAQ or the S&P, right? Technically speaking, on Thursday, small caps breached the low of the Wednesday session, right? And when you breach that low into the gap, you would expect, especially if small caps are sort of signaling that, hey, we don't really think that the CPI thing's all that, resolved yet, you would think that stronger sellers would push for this. That did not happen. We closed inside that range. Obviously, Friday's gap up keeps us sort of, at least as of the close, over the Thursday high. I guess what I'm getting at is, even though we're still underneath the 227 level, do we have aggressive sellers stepping in to push prices lower or just unload small caps? The answer to that question is seemingly no. So again, very open-minded at this point in the market to a wide variety of outcomes. It would seem as though, the title of the video today, the crash seems to be canceled as of right now, but it's really reliant on a couple of key things, a couple of key level holds in the S&P and the NASDAQ to get us out of this neutral trend, right? When the trend is more firmly in the upward direction on weeklies and dailies, then I will confidently say, yes, it's over, the crash is canceled, not going to happen, right? So anyhow, let's move along. Let's take a look at the Rusty Russell market internals. This one is a pretty deep dive video today with a lot of time spent on the individual indices. Anyways, what do we have? Volume flows Friday, just not there. On the Friday session here from the advanced decline line, not there. And the cumulative build builds out bearish on Friday also. So maybe a bit of a counterbalancing point to the analysis conducted here. I think you keep it simple here in small caps and you say, are we over or under 227? Bullish, bearish. I really think it has, for me at least, that's what it will be. That's how I will approach that this week, okay? Let's quickly take a look just to be congruent over here out of the market profile on the Rusty Russell. Let's see where value is developing. Yeah, notice on Friday, value is, I guess, in the midpoint of the range overall, but certainly not slammed towards the highs. It is still overlapping to up from the Thursday session. So what you have to just be cognizant of here is that the short's probably not going to step up until you start breaching this value area low area, right? Value area low area. This value area low level, we'll say that. So 2270, if that breaches, definitely looking for some downside, and that's probably where the beginning stages of the gap close happen. Understand that this would be a headwind for the S&P 500. With that, let's jump into some sectors here, because the sectors will help us along with the analysis of the S&P 500. Let's actually just keep this up for a brief moment and talk about the weekly performance. What do we see? Semiconductors lead the way, up 7.13% as measured from Monday's open. Financial sector with earnings up 6.69%. Materials up 6.14%. Really lightweight sector here, not that concerned, but this is a heavyweight risk-on sector. This, of course, is the second heaviest weight risk-on sector as well. Energy follows it up as the I guess it would be tertiary if you want to exclude this as technically not being a sector. If we look at the bottom end of the barrel, it's just laggards here. It's the healthcare sector, it's consumer staples, bonds don't really count as a sector, but then you have communications down here. Communications are slightly more risk on and they are medium weight, but XLV is the D for defensive heavyweight sector. It's now the fourth heaviest weight sector in the S&P. Not really the worst thing in the world to see that underperforming the market here, as well as the XLP underperforming the market as well. Consumer staples are lightweight and they are D for defensive, so posture there does strike me as an improvement on the heels of the weaker close that we saw literally last week. Let's take a look at the structural charts here. Semiconductors continue to just pull the market's chain, so to speak, and they can't make up their mind in the balance range. So look above and fail, technically completed to the bottom end of the range, but no lower high underneath. 256 Friday accepts above. Not to say that it can't come back down into range, but generally speaking here, what's the idea, right? As long as this remains neutral, it's very difficult to be an aggressive bear in the notably tech sector for the market, which of course the S&P is heavily influenced by anyways. So SMH, if it's over 256, show me the money. Maybe like the fourth time's the charm. 1, 2, 3, fourth time's the charm, perhaps. We can close that gap above. That, of course, should fuel a move higher in the S&P and the NASDAQ. So watching 256 quite closely. If we're in the range, you guys know the deal. Treat it for what it is. It's a balance until proven otherwise. Next up, XLF. Financials, really strong. CPI as well as earnings on Wednesday from JP Morgan, and the likes, basically, all the big banks there, really sending prices higher and most notably getting follow through into the end of the week. It's not like this was just an earnings pop and fade. That would have been more concerning underneath the neckline of this, head and shoulders from in the past, but the fact that Friday and Thursday both closed daily bars over 49.60 is pretty telling to me. And noting that this is the second heaviest weighted sector in the S&P 500, it's probably influential enough to say if we get any higher lows over 49, which is, you could think of this as being some sort of twisted, inverted head and shoulders, or like a double bottom neckline, if you will. It's a lower low double bottom from here to here, whatever. Over 49, a higher low gets set, and suddenly we're starting to deal with now a daily uptrend, right? Higher low, especially now that we have the higher high on the table as well. So a daily uptrend that emerges, it's game on for being bullish in the S&P 500. Next up, materials. Big counter trend rally. It's a lightweight sector. Do I think that there's anything interesting really happening here? Not really. I would sort of just, let's keep it in the spirit of, making up some time that we lost to the overly detailed analysis perhaps in the S&P and NASDAQ. Let's just keep it brief here. Counter trend move, big opportunity for a lower high in the midpoint of the range, not much to read into. Energy, it looks more like a sine wave, right? It posted a little bit of a mathematical joke over on X this morning. It looks like Y equals sine of X, right? This is just like, it's not... It's a crazy looking chart. It literally looks like a sine wave. Is it inflationary? Probably. Does it avoid a recession because, there's no breakdown here? It seems like there's demand for energy. It seems like there's demand for oil. I mean, you could look at crude, obviously, which is pushing this to some degree in the upward direction. Is there demand? Is this avoiding the big breakdown under the dangerous lows? Absolutely. So recession word, that kind of evaporates, right? That's not really a tell here out of XLE, which just generally speaking is probably more euphoric, more bullish for markets, right? Let's go over to industrials. Again, let's try to make up some time here. It looks like a lower high opportunity for me, but that's a weekly lower high. Daily already has the higher high. I would think that a higher low cements a new possible uptrend. So you're dealing with like the opportunity basically for new uptrends to emerge across the market. If that happens, of course, we'll be more bullish in that S&P 500. In the intro, I mentioned that there was one thing that's still slightly dangerous or a problem. We have not gotten to that yet. If you've made it to this point in the video, I'm sure you'll get there anyways, but it's going to be Apple. I won't keep you waiting any longer. It's Apple. We'll get there in a moment, okay? Apple is, easily the third heaviest weight component in the S&P right now. It's just ugly. It's an ugly daily chart. Anyways, real estate responding to some of the relief out of interest rates. If you get a thin structure retracement, small bullish pressure, upward pressure, but not going to move the needle for the overall market itself. itself. New swing lows highs are what we're looking for there. XLY gapping up and over the top end of this range here is impressive to me. I would want to see this build out now as a firm double bottom neckline recapture. Keep price over 227.50. I will be bullish the S&P 500, or at least have bullish underpinnings and be thinking about it through that lens. If we fail underneath, a little bit more neutral, open-minded to a wide variety of outcomes in the S&P utilities. As a proxy for bonds, basically not a shocker to see them higher here as rates back off a little bit. Watching to see if we get a higher low. This is a D for defensive sector. It's also lightweight. If it does produce this higher low, it's fine. Upward pressure is upward pressure. If it breaks back down into the range, I'm also really not as concerned from utilities. The tech sector is definitely where we do have some concern, and obviously this is more similar to your SMH, but you can see with, of course, the struggle from Apple on Thursday, it's not even close to the previous all-time high. It's not even close to the all-time high. I mean, it's in the midpoint of this range versus the SMH, which is towards the top end of the range there. It's looking pretty balanced. I would have to say, I guess, balanced inside of this range. The midpoint, you're in the midpoint. Don't enter in the center. Don't exchange in the range. Don't fiddle in the middle. No good on 234. If it sets a lower high, I would be concerned about equal low breakdowns. That, of course, changes my tone to bearish, noting that this is the XLK. It's the heaviest weight component of the S&P 500. If it can resolve this and get consolidation over 234, that would be helpful, but I would really love to see it over 238 if we're going to say, okay, everything's firing on all cylinders for the S&P 500. Again, not the end of the world, this chart, but just not really helping. Not helping the long case, not helping the recovery case for the S&P 500 in particular. Let's move along to communications. Medium weight sector. I like the opportunity for a higher low back in here. Failed breakdown sets up some sort of inverted head and shoulders. I would probably be more optimistic about this chart if we were to get over 99.15, the 100 mark back here. So good, decent first steps, but certainly more of a bullish tailwind, for the market if we see something like this develop into the future. New swing low here gets dangerous. This gap close, again, wide variety of outcomes, keeping an open mind to S&P downside if communications fail. And notably, what you could just watch here, of course, is the big bad Netflix earnings coming out on, is it Wednesday after the close? We'll take a look. Tuesday after the close. We'll take a look at the earnings calendar in a moment. TLT, my short strikes were not assigned. I almost wanted them to be assigned at 85. Probably would make a little bit more on the shares themselves other than just collecting the premium. But anyways, the trade lives on. Still short 85 puts on the TLT going out to, what is this expiration? 21st of February, something like that. Midpoint of Feb, so premium decay is nice over the last couple of days. That's fine, just to keep you abreast of that. Again, if I ever have a swing trade on and we're talking about the chart, I'll let you know. Usually I'm just flat as a day trader coming into this stuff. Anyhow, that's going well. I do think that there's an opportunity for a lower high from a very classic trend following perspective. I mean, this is a very ugly downtrend here, right? Any sort of lower high, any movement back down underneath 87.05, the bottom end of this range in here, it certainly puts into play this gap again. It's, ironic how it's sort of gapped a similar range from here to here. But I would think a lower high pressures bonds lower again. And I certainly think there's a world in which interest rates move higher towards the 5% target we've been talking about over the last little bit, even with the CPI report coming in the way it did on Wednesday. And we'll get to the interest rate talk here in just a moment, the CPI talk in just a second. XLP, consumer staples, lower high, D for defensive sector. I really don't see any issues with this chart. If upward pressure is upward pressure, that's fine. But any laggard activity just stuck down here, it's not going to influence the S&P 500. It's just too light of a sector, and it's also D for defensive. XLV, on the other hand, it's D for defensive, but it's a more important heavyweight sector. I would like to see this make a stand and try to make some moves in the upward direction. Sure, it's still a counter trend move in the context of this big breakdown, but any sort of breakouts, recaptures over 140.80 at least start some semblance of upward pressure for the market, even in a laggard D for defensive sector. So watching that closely for now. I wouldn't hold out on that. I mean, I certainly would think that if we're just following trend here, this is nothing more than just a bear flag on the daily, right? 50 SMA rejection. If it comes down into here, we'll consider it as bearish pressure, but notably watching most importantly, if I had to rank order your sector watch, it's got to be SMH, what happens with that range. It's got to be the XLK, what happens with the midpoint of the range, and then it's got to be the financial sector, right? Does it continue to hold up the earnings gap ups and not fade off some of those gains, right? Let's jump on over to let's get into the ratio grid here. Ratio grid shows us, again, nothing we don't already know. This continues to look a little bit more neutral on that XLK, which is what we described on the structural chart itself. This looks great on the move to recapture the 50 SMA. This is a non-issue because it's D for defensive. Ideally, this picks up, and we talked about that on the XLY. Anyhow, risk off is not a threat. Risk off is not a threat down here. Let's take a look at the specialized risk on, risk off relationships. A little bit more neutral, and just notice the theme here, right? Anything with the XLK attached to it is a little bit more neutral, a little bit not as good looking, but if you attach the XLY, if you attach the SMH, now all of a sudden, risk on, risk on. I actually really like the way that this closed over this prior high on the Friday session. To me, a little bit more of that, open-minded to a reversal here, a bullish reversal in the S&P 500 is sticking a little bit more so as these things maintain their look. The Japanese yen is going to be in focus here as we get to our fundamental outlook in just a moment. Understand that they are releasing some fundamental and also monetary policy changes on Thursday, I believe, after our close. So keep in mind, a yen carry trade can come back to bite us if this gets out of control. I think the market's well prepared at this point. The expectations have been set that there is going to be what would you say? There's going to be a hawkish tightening, basically, of policy over there, right? There's going to be a raise of rates. So the market's well aware of that. Unless it's way outside of the expectations, I would not think that the yen carry trade is like going to, cause a market explosion like what happened in August over the summer of 24, right? Let's jump on into the dollar. Speaking of currencies here, the dollar still has a path, in my opinion, to consolidate and continue in the upward direction, which in theory puts some pressure on the SPX over here. So we'll continue to monitor that. And for now, right, the sort of takeaway also is that gold has the opportunity for a retest higher low here on the relative ratio chart, right? And if that holds and rallies, I would tend to think, okay, maybe we do need more of that neutral stance here. So the data points, they're not firmly resolved in the upward direction. I really think that this neutral range really has shown us some neutral data points. And as they start to adjust back to being either more bullish or bearish, well, that's the whole reason of covering them week in and week out, right? Let's continue along to what do we see here out of interest rates we'd like. I'm a believer that interest rates can still get to 5%. We talked about that on the TLT just a moment ago, right? Reason being is that there's still an opportunity for a weekly higher low to be set here. Yeah, the daily didn't really hold up over that 46.50. Yes, previous resistance did not really act as new support, but in a world where the new normal, I know that term is like used and abused ever since the sickness, but with a new normal inflation rate that's somewhere around 2.5%, heck, even 3% on the core, you might just have to get used to a 10-year yield that's at a higher neutral rate, right? And that really boils down to a couple of these relationships. So let's take a look. 2-year, right? This is basically a proxy for the 2-year, is still underneath this area, has not broken out, meaning that we're not yet concerned about a hiking regime. If it does break out, we'll be worried about rate hikes coming from Mr. Powell. And then we could take a look at the Fed tracker tool. That's over here. And we'll get into our fundamental discussion real quick. You can see that after CPI, the odds got repriced for the June timeframe, which I'm a little bit of a naysayer on. I'm not sure that I'm convinced that that's the right call there. Of course, the data that supports this is the CPI that came in at the expectation, but still well above the previous read at a 2.7, right? If we just open up this chart really quickly, we can see that this is clearly trending in the upward direction. So I don't really think we're out of the woods from this CPI inflation perspective. The jobless claims came in a little hot on the Thursday session here at 217 versus 210 expected, but still well within the bounds of what I would consider generally low reads, which is just anything underneath 230. That's generally a low read there. You're seeing some anecdotal headlines about some layoffs in the big tech companies. They just make headlines because, again, they're the big tech companies and there's something to report that gets clicks, but they're just anecdotal. Until this actually gets out of control, we'll open this up one more time. Until this gets out of control with sustained weekly prints over and over and over again, over 240, until continuous claims gets out of control with a big upswing, I really don't think that the labor market's a big concern as of right now. What I do want to focus on, though, is just the CPI, right? And we'll have a brief discussion here. If we take a look at what's happening, there's a few things I want to bring up. Number one is that shelter has kind of stabilized here back at what I would consider just reasonable month-over-month reads, right, at a 0.3, which at this point is not going to continue to offer substantial disinflation, not deflation, but disinflation for the headline number. And you can see that energy, the volatility component, or the volatile components, energy and food are really what's starting to drive back some of the inflation uptick that we've seen over the last report, right? So that's kind of the reason that you look at core. And if we just think about, okay, if shelter's not really going to move lower, then we need these things to like maybe go through some seasonal ups and downs, energy ups and downs. But if shelter's going to stay the way it is, if it's not going to pressure inflation lower, and I don't think it's going to because of this chart here. So this is the PCE housing and utilities subset of the data, and that's the blue line, as you can see down here. The Zillow's observed rent index topped out, and then you see a top here, and there's about a 12-month lag. Right? And the point being is that where did this bottom out of rents? Rents basically bottomed in September of 2023. Okay, so then we should stop seeing shelter disinflation by September of 2024. And although, yes, it's moved lower slightly, I'd be interested to account for the latest data, which is coming out later on in this month, but to see if this flattens out. Generally, what I'm getting at is what do we see here? From point A, let's call this A, to B, you actually see a subtle amount of shelter inflation coming back. And yes, it's, underneath the previous, which was, pretty stable back over here. So we'll see if that resumes at some point. But the point being is if I just open up this chart now, and I know we're jumping quite a bit through the fundamentals, we're getting deep into the weeds here. Let's go to the CPI versus the Fed funds. And what I want to point out is that, this idea of a 2% inflation rate is really, we've only been underneath it ever since the GFC, the Great Financial Crisis, right? If you look at 2%, which is this green line here, and go back prior to that, really inflation had more of an average that was sitting somewhere around like 3% on the headline year-over-year number. It's only in the more modern era, post-Great Financial Crisis, that inflation has been at or below 2%. Obviously, the sickness, is a completely different story. But prior to that, I mean, you were hard-pressed to actually see the Fed keep inflation underneath 2%. Right? So that's just a little conversation point to talk about. And once again, why bother bringing this up? Because in my view, if inflation is going to normalize over 2%, which could be the case after we've gone through this big shock like what happened here, if that's the case, then your 10-year is going to find a higher neutral rate. So get used to like a 10-year at 5%, 4.5%, 4%, right? In that range. I think that's a reasonable thing to think about. The next thing to point out, just as we're still on the fundamentals here a little bit, is the classic chart of the Fed cuts rates and the market crashes, right? And usually that's because the Fed cuts rates in response to some sort of emergency. However, you can see there's one green line, and this is maybe what we're dealing with currently. The Fed is cutting interest rates into a some may disagree with this, but a booming economy with a ton of innovation on the way, the cusp of AI, obviously the quantum stuff, that's much further down the line, America's open for business, as they say. There's a number of things happening right now that, in theory, should support more of a booming economy. That's, almost like what we had going into the dot-com bubble forming. And you could say, like, okay, it's going to end in a Ponzi scheme at some point. Fine, whatever. But all I'm doing is trying to compare the most recent cutting cycle to maybe something that's more similar to what we had in 1995, where the market went on to continue to experience nice, pretty solid gains. And the reason I'm making this comparison, again, is because there's no emergency right now. The Fed does not need to bring rates to zero. We are not going to see something that looks like this, for all intents and purposes, this, right? There's no reason for the Fed to drop rates as aggressively when unemployment is the way it is. So if we get a mild cutting cycle that finds like a terminal rate here and it looks like 95, there you go. I mean, just there's a visual comparison for you. But again, from the inflation front, I think that checks out as well. So we're all set on this chart. I do want to get back over here, and I want to show you the Japanese information, what would you say? Japanese economy. They're getting some big data here, right? And generally speaking, we care about the inflation rate here, as well as the interest rate decision from the Bank of Japan at 10 p.m. So possibly waking up to an interesting Friday. Just understand that is on the horizon. The consensus here is for a obviously 25 basis point hike from the BOJ. If they go more than that, that's where I think the market gets a little uneasy, right? So watch this very closely. If you see this jump up to a 0.75, that's where we would have trouble on our hands. But a 0.5 is just fine, right? The market has priced that in already. We know that the Bank of Japan has been hawkish the last little bit. Let's talk about earnings, just a hair here. I find this to be very interesting. Everybody always cites NVIDIA for the largest contributions, to the S&P's earnings results. And ultimately it is, right, a huge part of it, obviously based on market cap. And you can see here the asterisk for not listed in order of contribution. But some of the other ones that I found very notable, just Eli Lilly, JP Morgan. I mean, obviously we have Google, Micron's on this list, which is not really a heavyweight component of the S&P. I find that interesting that it made the cut. More healthcare here, Amazon, just very interesting lineup. So I think that the story of 2025, and you can even see this if you scroll lower through the report. These reports are a very good read, by the way, if you're looking for casual reading on a on a Saturday. Where am I trying to go? I'm trying to go to the bottom where we have forecasts about the sector level growth. Sector level growth, where is it? Maybe up a little bit further. Thanks for bearing with me as I find it. I know sometimes it would be nice if I had this just pre-prepared. Here we go. This is 26. This is 25. Infotech's going to dominate, but notice that the delta between these two really isn't, it's not as substantial. I think what's substantial is the idea that healthcare is going to play catch up. I think the idea that utilities are going to play catch up. Financials are going to play catch up. Right, this to me, these projections, revenue growth, you could take a look at earnings growth here, of course, as well. You could see communication, anything that's sort of at parity, financials, there it is, again, overperforming. We're sort of on this turn where maybe the Magnificent Seven are not going to be the big drivers of the market return in 2025. And you can continue, it's talked more about in this report. I would continue to sort of skim through it at your own leisure, but a theme as we walk forward. Look for maybe some consolidation, right? And you can see this out of the charts themselves. Before we get into those charts, let's quickly talk about the earnings calendar. There it is. Netflix after the close on Tuesday is a top watch. I would say additional watches. GE Vernova is top of mind right now from the nuclear perspective as we think about additional indications, probably looking at American Express, maybe CSX and Union Pacific from a shipping and freight perspective. What's going on there? That has much more to do with industrials, manufacturing, of course. And I think as of right now, these things are maybe less important as we're in more of a knowledge and information economy than physical goods. So anyhow, GE Vernova, some of the shipping companies, freight, as well as American Express. What's the upper echelon, credit card swiper? What are they looking like as of right now? And you can lump in NEE as well with GE Vernova. In terms of the nuclear theme, okay? That's what we have on that, and things will continue to heat up the week following, right? The next week, not this upcoming, but the week after, big for our tech earnings, Magnificent Seven. Let's jump on into some additional indications. We'll try to, in the spirit of time, move a little bit quicker here. I always say that, but it never works out well. We take the appropriate amount of time to cover the data points that are relevant. That's my approach, right? Anyways, TLT ratio to the S&P flat down on the lows, not really indicating a flight to safety here. As we take a look at the bonds relative to themselves, pulling back, but still in uptrends. I would really want to see these uptrends break if we're going to be not concerned with inflation based on the conversation we just had. I personally think it's more likely that these catch for a higher low and loop back in the upward direction. It would be a slight headwind for the markets. Let's take a look at the credit spreads. There we go. Moving lower here, which is starting to show that volatility is maybe subsiding a little bit. I don't know that I believe that all the way. I would need to see it reflected in the price action first before I would align with this. Remember, price is what pays. This is ultimately just a supporting evidence data point. This one remaining pretty stable and sideways out of corporate grade LQD, in my opinion, is... Excuse me. Could not avoid that one. Could not keep that one in. LQD, a little bit more so of that indication of volatility still stepping up in the market. Let's move along, though, into our HYG in isolation, as well as the LQD in a moment. Notice the higher high here, whereas the S&P sort of has that equal high, so a little bit more of that bullish data point. Notice, once again, we cover all of these data points. You can keep tally. I, of course, have a tally myself going on a notepad. But as these things flip back and forth, I should maybe make that an Excel sheet, huh? And just maybe post what the data points look like. It's almost an iteration of the index score. Anyways, this is a slightly more bullish data point among the mix that we have right now with the positive bullish divergence. But if you throw in the LQD, what you'll notice here is just an opportunity that we're still underneath these lows. So it's very possible that a rejection that rolls over here continues to put the pressure on, which is, kind of a fun way of expressing a similar thing in the credit spreads, which is why your LQD here is still indicating volatility. Right? So just everything sort of comes full circle with that look. Let's take a look at Bitcoin as a risk appetite gauge. Big break out of the Saylor shift ratio, pushing positive here, green signal printing. This, of course, just avoiding the breakdown here. This printed a sell signal where we typically are looking for a close underneath the previous weekly low. Never happened, never closed underneath. Big move out of Bitcoin in the upward direction. That, of course, seeming like a risk asset. Some people are, equating it to the inauguration, of course, the new administration being very crypto friendly. Maybe that's the case. Regardless, just looking at price, this has to imply more of a risk appetite out there in the financial markets. So that would be bullish for the S&P 500. Let's look at breadth. Subtle improvements here. Let's zoom in on this. And we made this comparison last week, and I think it's still a very valid comparison to use as a base case scenario. If you look at what happened here, we saw these go negative, right? Mainly the 50 SMA, that's the blue line, then the green line's the 200 SMA. Breadth was negative. We saw this little counter trend move before dropping, but what you'll notice here is there was already a much more substantial, actually, maybe not so much. My apologies. Maybe I was thinking about a different. Yeah, maybe I just misinterpreted that one. I was coming in hot with that confidence there, not so much. I was going to say that as of the cross, yeah, I guess we were a little bit closer out of the 200 SMA here, actually getting negative already. So that's not the case. But anyways, still very similar, where if you take the cross through the zero line here of the 50 to sort of set the red line, you're also negative on new highs versus lows. This is just a little bit more resilient, I would say, over here out of that 200 SMA. Regardless, still an opportunity for a counter trend, still an opportunity for this to roll over, still an opportunity for this to come back down. Look at this. Look at this counter trend. Look at how this blipped higher before rolling over. So just keeping an open mind about breadth. And one of the ways you can continue to monitor this, perhaps without so much of a confidence hiccup there, is just your RSP, right? If the RSP stays over 178, then I would tend to think you're in good shape on the bull side, right? If this falls back down into range, that would be your first white, but also red flag to say, okay, breadth contraction probably pressures markets lower, and that's no bueno, all right? Let's take a look at QQQE, similar situation where if you just reject here and come back down into range, the level is going to be at 92.25. You guys know us, round numbers only up in the penthouse. If you're underneath that level, no good. If you're just in here, neutral, bullish, absolutely over 94. Let's take a look at the industrials versus transports. Just like the IWM, trying to get a little bit of a pickup there, but ideally, you've got to get some sort of rotation at least to recapture the neckline of the move here. Let's call that 17,000 flat. Doing my homework on the fly. Thanks for bearing with me. All right, there we go. Levels on the chart now. Let's jump into some volatility. VIX is continuing to remain suppressed. I think this is not a shock considering what's happening with the CPI result actually out. If we look at the VVIX, it's also sort of coming down a little more aggressively here underneath the 103 handle, which is good. It's a little bit more bullish for equities down below. Most importantly is this new chart we've been tracking here on the channel. This of course takes care of itself. It's kind of mild. It's not really in comfort zone, but it's not discomfort over the top at 2145. This is near the zero line. We've covered that, but this really, I think, becomes the new bread and butter of the volatility dashboard, if you will. Reason being is just that it's so, you can see out in time just based on these levels here. So currently in a very strong contango, avoided the zero line test out of the current months, right, versus the back months, which were at zero. And I like the fact that these are still holding up. Notice that this is going sideways as this is coming down. If this was really more of an aggressive downtick in the back months, I'd be more concerned about that. But the fact that this is sideways, the fact that this is sort of like holding up here, the fact that this is getting an uptick, these expire in 4 days, by the way, the most recent one, the F contract. But generally speaking, this volatility posture does seem a little more bullish than bearish here as we come barreling into what the market's presenting us with, which is kind of that neutral opportunity in the S&P, a little bit more bullish in the NASDAQ. I think this, of course, being a little bit more of that bullish data point, supports some of the ideas we've put forth in today's episode. All right. In the interest of time, NVIDIA, daily charts here. What do we see? NVIDIA is just in a range. I think one of the things that needs to be accepted, myself included, right? One of the things we need to accept is that NVIDIA is just in a range. It's no longer in its mind of its own, just clear blazing uptrend in the upward direction. It's in a balance range. So does it make sense to use range rules, long the lows to the highs, short the highs to the lows? Sure. Where are we as of Friday's close? The midpoint, right at the 50 SMA. I think that the biggest inflection point here is 140. If you can Brigade bolt over 140, there's some interesting thin structure to retrace in here. Here it is on the hourly time frame chart. So consolidation, whatever happens in there, I would tend to be more interested over 140 on the long side if we're trying to find longs and you're not already long from the lows. That's maybe interesting for risk reward, and then ideally trying to balloon runners. This section right here, this segment of price between 143.25 and 149.25 is the most interesting area for me. So, sure, this is great for this trade to unfold, but this, I think, is the bread and butter of where that strategy is going to work best through the thin structure retracement. All right. So that's my take out of NVIDIA. Anything in here that dribbles back down to the lows, call it for what it is. Big time lower high, equal low threat, certainly suggests that if the balance range is going to break, here's your H pattern, right? Through the lows at 129, first stop 124, and then you're, easily starting to talk about 115 over time. We'll take it one step at a time. We're not there yet. This is not a bearish call. We're still in the range. One step at a time, 140 becomes a top watch. If it rejects and rolls over, 129 becomes the threat. Next up, Microsoft. Earnings a little bit further out, not this upcoming week, but the week after that. Balance range here, trying to resolve higher, but one of the tricky things about this is just that every single gap up has faded here. You're at this area of potential resistance. I mean, maybe consolidation here for a Brigade Bolt gets interesting. I really don't like Microsoft's daily time frame chart. The moving averages look like spaghetti through here. It's not cleanly trending. It has not been trending for a very long time. This is sort of just a big equilibrium if you're to look at this from like a monthly perspective. Be my guest if you want to build stronger ideas and theses on Microsoft, but I think waiting for earnings is the right call here. Give me some clarity on the chart, get out of this balance range, get back up here maybe, and we'll go from there, but not good, not good. And when there's nothing clear, like that's the thing, you don't have to force a trade on Microsoft just because like, oh, it's part of the core list of companies. No, if there's nothing to do on Microsoft, there's nothing to do. This is one of the struggles. This is one of the issues. This is the data point I was talking about in the introduction that poses a threat for the market. It's simply the fact that Apple produced a lower high under the 50 SMA, big algorithmic selling on the Thursday session, no hold of this previous retest area for an all-time high, Brigade Bolt that looked like this. Nothing of the sorts. So as Apple consolidates around 230, I would really stay away from big bullish ideas down here. It would have to turn into an inverted head and shoulders, some high or low acceptance over 234.50s if this is going to play back in the upward direction. If you think that Apple is going to come a little bit further down into this 220 zone, these lows over here, if you think that this breakdown is just the start, and again, here's that algorithmic selling, let's even bring you to a 5-minute time frame chart. If you didn't see this on Thursday, then number one, you're living under a trading rock, but number two, take a look at that. Just absolutely annihilated on that Thursday session. And again, very clearly, like this is not Timmy and Jimmy and Sally Sue and Uncle Joe selling their 10 shares of Apple. This is like, this is a big deal. So given that information, let's go back to an hourly here. Again, I don't think that Apple is going to be much of a tailwind for the S&P moving bullish. I think that it's actually going to cause much more of a threat. So in this range, I think we're just at one step at a time, a little bit more bearish than it is bullish. Anybody who is trolling me over on X about shorting Apple up here, take your victory lap. Right? Go ahead. I think that, anything that looks like this, it's just going to be an issue for the S&P. So not out of the woods. This is not approximately, let's get you the actual number. Let's go to the Analyze tab, Fundamentals. Let's go SPY. And let's see. Apple is currently sitting at, it is back up to the top dog. Unbelievable. I thought that NVIDIA and Microsoft had it beat, but apparently not after these big pullbacks. Apple is top dog here at 6.84% of your S&P 500. There you have it. So is the SPY going to easily move in the upward direction if the top dog is chopping around through here? I think it becomes a tough argument to make. Absolutely a tough argument to make if Apple looks like it's going to remain weak and move like this. If there was going to be any counter trend move, right? Here's another takeaway. If there was going to be any counter trend move, then the gap up open on the Friday session, not really a gap up relative to the range of Thursday, but gap up disjointed from the Thursday afternoon lows and really just the slower grind into the afternoon. This should have squeezed shorts off the open. That, of course, did not happen. So Apple, conversation complete, mission accomplished. Let's move along to Amazon. Means we're going to have to reorder the core list of companies here. It goes by market cap, or at least it used to. Amazon looks great. I think Amazon is one of the stronger names because this is a heavier weight component. Let's jump over here. Where's Amazon? Let's take a look. 4.09% should be. Amazon, there it is, 4.09%. This looks great. I love the bull flag here on the daily and weekly perspective. I love the hold of the 50 SMA. I love that this range here has played nicely, look below and fail. In theory, with the hold on Thursday's lows, Friday accepting outside of that Thursday range should be the top end of the balance at 232.50. Looking for Amazon longs to that area on sustained holds over 225.25. If we can get that, right, you get some sort of ideas that look like this. Brigade Bolt over the Friday high into 228.75 all-time high. After that, if it pulls back here, still open-minded for potential longs. It wouldn't be as good in my opinion looking for that level. I really think now at this point you got to see it stay over 225.25 for that follow through in the upward direction. Otherwise, technically it's just a balance range until proven. So this, if it's going to play, should go sooner rather than later. Basically, that's the takeaway. Google, what do we see over here? Ugly chart like Microsoft. There's nothing to do. Technically, it's bullish, right? If you were to zoom out, we don't often do this in the core list of companies, but we'll do it for Google. If you were to zoom out, it's a cup and handle. If you were to zoom out, it's a bull flag over the previous all-time high. I get that, but on the daily time frame chart, as I'm looking for clarity, I mean, maybe like Amazon, it's a bull flag here, but this range has been dreadful to trade. You can tell I've just removed all of the levels that I've had inside of this range. I just have the prior all-time high and this 198.85 level, excuse me. If we get consolidation in the upper 50% of the range, great. We'll scout it for a breakout. If we start moving into the lower 50%, maybe there's a long off the lows. Google's been tough for a while now in this balance, so I think just one step at a time, watching for the overarching range is the best outcome there. Metaverse looks much better. The 607.75 level has been key in this name. Got the nice hold there on the Friday session after a very volatile dump off of the open. Regardless, it's holding up where it should, and it closed above. So as of right now, it's got to continue to be on the long side, right? Holds of 607.75, Brigade bolts over 615, target the high of day there, ultimately the top end of the range. The daily chart looks great. You had this, try to build out a block lower. Now you're accepting back in that upper block. As long as price is over 607.75, looking for that rotation into 635.25. So intraday levels can play off of those little gray dotted lines we had. So Tesla is up next. Here is the double top. We have an inverted hammer, a big one, on the Friday session, but it's over the double top neckline at 415. On the hourly time frame chart, I think that this is a clean build in the upward direction, if you will. We have previous resistance, offering some sort of Brigade bolt over the level at 426.85. So long as we can hold that, I think we're rocking and rolling back to an equal high, if not trying to poke up here to a 466.50 target. If it does pull back a little bit deeper, not the end of the world, and you could probably even strike a trend line here. I haven't done this yet, but yeah, there you go. Depending on where that trend line comes in, maybe you get a higher low, maybe it's still in play over 415. My take would just be that if it can stay over this, it's like optimally bullish looking for upside. If it gets here, not the end of the world, still maintaining the bullish stance over time, and perhaps it's just this as a secondary bolt over the 426.85 level. It's an idea. I would not be aggressively short Tesla unless there's a big time one of these and probably even a breakdown underneath 400, right? And man, it's tough to be short Tesla under these circumstances, just noting that the daily 50 is here. We still have that daily retest level around 358.50. Tough to be short Tesla. I think scalps can play. Don't overstay your welcome, though. That's the name of the game there. JP Morgan, absolute rocket ship. Earnings went great. Big move in the upward direction, helping push the S&P 500 higher, as we know. And very, very simple watch. We're on the hourly chart still. Let's go to the daily. Here it is. This is absolutely acceptable on the daily time frame chart. As long as we're over 248, bullish for the S&P 500. On the hourly time frame chart, as you can start to see here, bullish consolidation over 255.50. Brigade bolts into blue sky territories, rock and roll. It's just, bulls on parade. Helping out that S&P 500. If financials remain strong here, it looks good. Netflix is a patience play. There's nothing to talk about here with earnings on Tuesday. Be my guest if you want to swing trade options through it, but this historically has a big gap in, not in this cycle, but here, historically a big gapper through earnings, and you guys know me. My take is that after earnings is when it typically tends to build out these cleaner trends. Right? So this is post-earnings, this is post-earnings, this is post-earnings here, post-earnings here. So I'll be waiting for earnings to pass on Netflix, which means we can segue directly into the three trade ideas. AVGO, there we go, is first up on the chopping block. Daily is still in this range after the earnings gap up. I think it's strong, though, because of the way we have an inside bar setting up a 3-bar play on the Friday session. And if we can break that Thursday high, technically Thursday is a red bearish candle, it would just indicate that any shorts, even with the best possible trade locations, should squeeze. If we look left, oh, look, there's even more structure back here as well. So I think Broadcom is a trade idea. And, you could pattern traders maybe say it's one of these inverted head and shoulders. That's fine. Any consolidation here, Brigade bolts over 240.25. I'm looking for longs there on your retest higher low entries into the all-time high 251. 251 is the target there. Next up is another one. It's maybe like a sister setup. So maybe I should have said 2.5, but QCOM. Qualcomm. What do we have on Qualcomm? Take a look at the daily chart. It's also offering that 3-bar play where you have an inside hammer on the Friday session. And look at this. Let's just bring this down to the opening print of the Friday session is what I was aiming for there. And you guys know us. In the penthouse, it's round numbers only, so let's go 165.50. Over that level, look left, there's nothing but thin structure. I'm not calling for a full rotation to this open up here at the 180.25 level, but my goodness, there's not much in terms of structure off to the left that we have to pay attention to as a big threat. I would say, if anything, you might have 173 as a potential headwind area. Let's do something along these lines. There we go, all set. So Qualcomm, if it can produce this, Brigade bolts, rock and roll, 173. Next up and final trade idea is SQ. What's going on with SQ Square Block, as it's known now? I think that this is bearish, right? You have a very clear head and shoulders, 1, 2, 3, right shoulder. Here's your neckline. 50 SMA is there. Break, lower high, setting an inverted hammer on the Friday session, looking for continuation to the downside. If the broad market crumbles, then I'm not going to be looking for those semiconductor breakouts that we just saw in AVGO and Qualcomm. I'll be looking here at Square to reject off of this neckline retest, daily 50 SMA, little inverted hammer, doji-esque style bar. Taking a look on the hourly time frame chart, all I would sort of be looking for is any acceptance underneath this area right here at 86.75. If we start accepting underneath, I would be looking for this back down into 82.15. And again, it would help if the broad market was bearish as that breakdown was taking place. Obviously, what we're trying to exploit is risk and reward in the downward direction. That's all I've got for you in today's episode of the weekly watch list. Air quotes around "that's all I've got," as if it was not very much. It was quite a bit. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that the market is closed on Monday. We may or may not do some sort of like Q&A for a live stream on the Monday morning session just to come hang out with the whole crew up for the holiday session. And we'll take it from there. Just subscribe, turn bell notifications on, and you'll be alerted if we fire up the live stream Q&A. And with that, enjoy your weekend. Have a green trading week upcoming, and I will see you in the next one.